day, guys. It's such a pleasure to be here to speak with each and every one of you. My name is Roderick. I am the CEO of Third Eye Traders. And in this course, we're really going to go over what Forex is and all the things that you need to know in order to make money within the financial markets. There is so many videos out there about what is Forex. Some goes into, you know, the basic information, but we're really going to visit the basic information and we're going to walk into the intermediate side so you really have an understanding and what really matters when it comes to Forex. Now, just a quick disclaimer, guys. I am not a financial advisor, right? I've been trading for years. And even though I've had a lot of success, I've also had a lot of failure. So you just have to keep in mind when it comes to trading that there is risk that is involved, and you might want to consult with a financial advisor if you're kind of on the fence or before you even get into the market. So now that that's out of the way, let's kind of dive into the meat of this topic, right? So when it comes to Forex, like history does not matter, guys. We get a lot of people that try to tell you, hey, go back to the bargain system, all this nonsense, none of that matters. So we really want to just get directly to the meat and what really matters when it comes to Forex and what you need to know before you enter your first trade if you haven't already done so. All right. So what is Forex? The abbreviation for Forex is FX, and it stands for foreign exchange. Now, Forex is basically a process of two currencies exchanging for one another to gain a profit. That's whether you are buying or whether you're selling. All right. So you can make money on both sides of the market. And it's also a $5+ trillion that moves through the Forex markets on a daily basis. Now, most people have heard of the New York Stock Exchange, and if you are familiar with the New York Stock Exchange, then you know they move about 22+ billion a day. So in comparison to Forex, I mean, it's massive, right? In terms of, I mean, we're talking 10, 50, 100 times more what's being moved in the Forex market in comparison to the stock market. Now, the Forex markets are open from Sunday to Friday, 5 p.m. to 5 p.m. That's when a cycle of that previous day closed. And so we're looking for the market to begin on Sunday at 5 p.m. and close at Friday, 5 p.m. And guys, I am on Eastern Standard Time. So just keep that in mind when I'm speaking in terms of times later on in this presentation. I also will continue to remind you. Now, when it comes to when you enter a market, right? Like I mentioned, how you can make money on both sides of the market. You know, there's two ways that you can enter into the market. You can buy into the market or you can sell out the market, right? So if you're buying into the market, you're expecting a particular currency to appreciate. So in this example, we decided to use the Euro USD. And so if you look at the Euro, on this side over here, excuse me, if you look at the euro, then you'll notice that the market is going up. You can see a slight uptrend. An uptrend, if you do not know what that is, we will cover that later. But an uptrend is basically moving in a forward direction, right? And so due to the euros on the left side, that's basically telling you that the euro is actually appreciating against the dollar. So it's actually stronger than the dollar at this particular point in time in the financial markets. Now, if you look when the market basically peaked at this nice little zone where you see this rectangle here, then you notice that price turned around and then the US dollar took over, gained strength, and that's when the market started to tank, basically. And so, in comparison, when you're looking at when the market is falling, the currency pair on the left side is losing against the currency on the right side. And the same thing if the currency is going, the basically the pair is going up or the candlesticks are going up, then the pair on the left is stronger versus the currency on the left in this pair is stronger than the currency on the right. And so that's really what you need to know when it comes to financial instruments. So if you see something going up, then just know that the currency in that currency pair on the left is appreciating or is stronger than a currency in that currency pair on the right. And if the currency pair is going down, then vice versa. You get it. So what is currency? We get people to ask us this question all the time because people really don't really understand what it is. So currency is only valuable because the government validates it. So because I'm in the United States, right? So because our government say, hey, the dollar is what we use, the dollar is a means of exchange, then we use it and it has power. But when people believe in government, that's only when people believe in government, right? So this gives the currency value. Now, when people stop believing in government, that is when a currency could collapse. So we will look at that as basically pure manipulation. And the reason why is because when you really look at a currency, people really don't have power over it, right? It's all controlled by government. It's all controlled by those who are in power. Hence, this is the reason why Bitcoin was created, right? Because it didn't want a government to control a means of exchange. So that Bitcoin was created to give people power, basically to be decentralized. Meaning, and I'm gonna go over that in that slide. The central bankers, right? Central bankers are those who basically impact our monetary policies, and they choose to inflate or print more money or whatever the research that they may have received tells them that they should do, that benefits that country at a particular point in time. Now, what moves the forex markets? Okay, this is really important because if you look on most websites, it's going to tell you something along these lines. Financial markets are moved by supply and demand. But what we know and what we understand and what we're going to continue to harp on, even while you are learning with us, is that it's pure manipulation, right? We understand that. And so when you look at these movements could be impacted by monetary policy, which I just mentioned, interest rates, central bank policies, political involvement, economic growth, and currency devaluation. Now, let me put this in simple terms, guys, because this is extremely important for you to understand. If we're trading in the forex markets, all right, and all these things could possibly impact our trades, then what does that tell you? Well, I can tell you what that tells me. That tells me that these are just really excuses to serve to manipulate the markets. No matter how you look at it, these are excuses for them to do what they were going to already do anyway, right? And so I just think it's really important for us to keep that in perspective, because when you understand that you're not in fully control, then our job is to trade in alignment with those who are in control. And so we're going to teach you more about what that looks like and how you can benefit from that later. Now, who controls the markets, right? So if you notice, forex markets are created by market makers, brokers, etc. An example would be Citadel Securities, right? So Citadel Securities is one of these securities brokers who create market structure, and they sell templates to brokers, etc., etc., etc. Now, liquidity providers are clients of market makers. Now, liquidity providers would be basically big banks. I mean, that's really who they are, to simplify it. Banks are supposed to take on orders from these brokers, and to fill these positions or our orders. So let me explain this. So let's say you enter into, let's use Euro USD since you are familiar with that from the beginning of the slide. But let's say you're entering into Euro USD. All right. And you want to make money, right? That's your goal. So you're buying into the rally, you're making money. Well, what that broker is supposed to do is send your order into the market where liquidity providers basically back it. The thing that actually happens with a lot of brokers, and we'll go more in depth about this later because I don't want to lose you, because it's a really complex information that we're gonna have to simplify for you. But brokers, for the most part, will sell your positions to those banks. Now, I mean, if you have $200 in your account, right? I mean, you looking at banks, well, your money is probably already in a bank. So your money is betting against your money. So they basically taking you out of your position. So you just have to keep those things in mind when investing into the financial markets. Now, retail traders are us, right? So our capital does not move price, but it does influence the direction market makers will take the markets. And what I mean by that is market makers, they have ways to identify where price action is because they create that, but they can see where most people place their orders. And those are the position they sell to their liquidity providers. And so you just got to be extremely careful. And that's why we teach you not to trade every single day, right? We look for certain setups and then we ride that wave. Now, you have to keep this in mind. Market makers are looking to take price in a direction away from the majority of traders. So if 80% of traders are on a sell or trying to sell or have sell orders in, then you can believe they're going to take that in opposite direction and on a buy. And so we're going to show you a lot of different ways and strategies that you can be trading in line. That way, um, you are making money when it comes to trading. Now, we trade a lot with price action. We use some form of technical analysis, but we're going to go all over that later, right? Let's just keep it simple. So now we're going to go. Now, listen, let me take a second and stop and say this, okay? I know your mind is probably like, wow, like, I really can't believe this. Like, why should I trade? Like, you're probably thinking so many different things, asking yourself so many different questions. Well, we believe in teaching you not only the concepts, but also what these manipulators are doing. So you are aware. It's kind of like if you get in a relationship with someone and let's just say they might not be a good choice of character, but they're hiding that. I mean, you wouldn't really like that relationship. But if you knew about that individual, you have the power to make a decision about how you want to move moving forward. And that's what our course and our program is going to help you with, right? We're going to get you the information that ultimately is going to leave the decision in your hand. What do you want to do? Right. And so let's move on to some terms that you should know because it's really imperative that you understand these simple concepts before you even place a trade. Okay. Now, what is spread? Right. Now, this is really important because the spread is the fee that brokers charge to receive a commission with every trade that is placed. And so, what that means is basically this is how the brokers get paid. So the bid is the price in which your broker is willing to buy the base currency in exchange for the quote, which in this example you will see that is titled counter currency. Now the ask is the best price available in which you will buy from the market, right? So that's where you enter into the position. Now the spread formula is the difference between bid and ask equals the broker's commission. Um, and this is really important, guys, because when you get into the market, you might have a certain position or level that you are in, but you also have to keep in mind that not only you enter into that market in the area you're thinking you're entering in, but the broker's gonna have to get their commission. And that's why when you enter a trade, you're basically negative because you're negative of the amount of the commission that is being charged for that broker. Now, to explain this in simple terms, this example here, if you're looking at Euro USD, so we'll keep that consistent. Let's say the bid price is 1.1051 and the ask price is 1.1053. Well, all you're doing to get the spread is basically taking the ask to minus the bid, and that's how we were able to get you 2 pips. So to have that position open or to take that trade, it basically costs you 2 pips, and that is the broker's commission fee. So I hope that makes sense. Now, moving on to leverage. Now, this is extremely important because leverage is the ratio of traders' funds to the size of the broker's credit. So, this is basically what the broker is going to give you in order for you to trade that amount that's in your account. So, here's an example. So, let's say a trader has in his or her account $1,000, right? The brokers gives you the flexibility of trading basically with $10,000. Now, this will be equivalent to a 1 to 10 ratio. I mean, you might hear others say 10 to 1 ratio, but it's a 1 to 10 ratio. Okay. Example two, just to kind of show you another example, keep it simple, easy math. Let's say you're doing same thing, $1,000, and you're able to trade with that broker's credit up to $100,000 based on your position size. Now, that's going to be 1/100. All right. So this is a 1/100 ratio. And so if you look into your brokers, and we'll create a video so you all can see what that looks like. But basically, when you open a demo account or you open an account completely, basically it'll ask you what leverage do you want to use. It asks you about 1 in 200, 1 in 100, 1 in 500. Some have 1 in 1,000. And so this is basically easy math to show you how much money you're trading. So what does this mean? It makes your losses and profits more aggressive. So the higher the leverage that you decide to choose with that particular account, then you can basically maximize your profit or you can maximize your losses. And so we just want you to keep that in mind too. So now, what is margin? Margin is basically a required deposit you must maintain in your account to have an open position with a broker. So you will notice there's a percentage, and this goes hand in hand with leverage, right? So if you're using a 1 to 100, 1 to 200, 1 to 500, all this goes into play, understanding the margin, how much you have left in terms of if you're down a trade or if you are up a trade. It's really important that you um, choose a reasonable leverage, something that you can maintain and do, guys. Right. So let's just move on to our next step. So, that part is simple. What is swap? So swap is basically what a broker charges you for keeping a position open overnight or after the closing cycle of that previous day, which is 5 p.m. So example would be, some brokers could charge you $3 per lot. So, if you have a lot in, they could be basically charging $3, if that makes sense, per lot. And if it's much smaller, so they can basically divide it up and then you get that amount. So let's say they charging you $3 per standard lot. You using a standard lot, but let's say your position is basically um, zero point 0.5. Let's just say $5 per pip, right? And we'll go over all that in another video breaking down pips and kind of what that looks like. But let's just say you're using a 0.5, which is $5 per lot, $5 mini lot, excuse me. So that's basically going to give you $1.50 for that position. If they are charging theoretically $3 per standard lot. Just giving you a quick example so you know what that looks like. Now, what are the different trading sessions? So again, guys, I am on East Coast. So you have Sydney, which is from 5 p.m. to 2 a.m. You have the Asian session, or better yet known as Tokyo, for 7 p.m. to 4 a.m. You have Frankfurt from 2 a.m. to 11 a.m. You have London from 3 a.m. to 12 p.m. And then you have the New York session, which is from 8 a.m. to 5 p.m., right? That's why we pretty much on business hours from 8 to 5. And so if you're in the United States, if that never made sense. Um, but yes, those are the different trading sessions that you can trade. One of the things to keep in perspective when trading different sessions, certain pairs move more during certain sessions. So, if you're looking at JPY, pairs that are ranging with that have JPY, which is the Japanese yen, then you might see some movement for them within the Asian range, right? I mean, it's an Asian pair. I mean, Asian currency, and so if you're looking at stocks like keep it consistent Euro USD, you can potentially for sure get movement within the London session, Frankfurt session, and New York session. But if you notice, the bulk of most of those, or there's a time I say a time gap, and then you have also a time where they run together. Those are going to be your most explosive times if you're trading certain pairs. So I hope that makes sense. Now, what is a pip? So a pip is a point in percentage and how the market measures small movements. Now, all pairs will either have 5 or 6 places to all together, right? So you will see either 5, 3, or 2 places after the decimal, depending on the pair or financial instrument. Now, I'm gonna show you what this looks like for each one of those categories. So whether it's 5 places after the decimal, 3 places after decimal, 2 places after decimal, so you can really understand. Because we have noticed that a lot of people will show you basically what 5 looks like after the decimal, but not really the rest. So let's just go ahead and dive into that, and so you can have a basic understanding in depth in what that looks like. Now, how to calculate a pip. All right, when it comes to pips, let me back up. So when it comes to GBP, excuse me, that's a typo there. Forgive me, guys. When it comes to GBP USD, let's just take a position of 1.38353. Now, if you notice, we broke it down to what that would look like, basically the place. Now, you would notice in this example, there's 5 places after the decimal. Now, the 5th place after the decimal is known as a pipette, right? So that would be basically 0.3 of a pip. Okay, if that makes sense. It's kind of like if I have to result it to time, it would be something like it would basically be the seconds. All right, and then the 5 would technically be the minute. Okay, and so in this case, the 5 is the 1 place, right? And so if it goes up to 1.3836, then you know it went up 1 pip. Now, if it goes to 1.38453, then you know it went up 10 pips, and so on and so on and so on. And again, just keep in perspective that farthest place to the right, that 3, is the pipette, all right, which you really don't count that. So let's move on to the 3 decimal places after the 3 after the decimal place. So you have USDJPY. So you have 102.840. The 0 will be considered as a pipette. So we really wouldn't count that. Okay. But you're going to start with the 4 being 1. Okay. And then if you look at the 8, that's going to be your 10th place. You look at the 2, that's going to be your 100th place. You look at the 0, that's going to be your 1,000th place. You look at the 1, that's going to be your 10,000th place. So that just basically give it to you in that perspective. And then let's use another example, like the US 30, right? The US 30, better yet known as the Dow, let's say it's at 30,149.22. Well, the 10,000 place is going to be the 3, the 1,000 place is going to be the 0, the 100 place is going to be the 1, the 10th place is going to be the 4, and the 1st place is going to be the 9. So it makes sense. Now, one thing to note when it comes to like the futures, right? That these are weighted in that dollar denominated currency. So if you're looking at the US 30, I mean, of course, that would be the US dollar, right? If you're looking at other futures like the German 30 or, I mean, so on, so on, you get the point. It would be in that country's denominated currency. Okay. So you understand the weight of that position. Hope that makes sense. All right. So, what are the different market orders? Now, this is really important, guys, because when it comes to market orders, um, we want to keep this in perspective. So you have market execution, which you can enter into the market instantly. You have a buy stop. So a buy stop will look something like this. So let's basically placing an order above the current market price. So let's say, prime example, the market is doing, something like this. And you think the market is going to go up. Well, you just basically catch that trade to the upside. And that's what's going to give you a buy stop. And so hopefully that makes sense when it comes to buy stops. Now, let's go ahead and look at a sell stop. Let's go ahead and look at a sell stop. So when you're looking at a sell stop, it's basically going to be the opposite. So you are basically seeing that price action, it's in its range, right? You're seeing price actions in its range. You're thinking price action is going to break below. So you're placing your sell to catching the downside. A lot of people typically do these with like M's. We call them, well, they call them second leg trades, where they're expecting price action to finish here and then continue to the downside. Now, let me go ahead and erase these guys. Give me a second here, eraser, so we can kind of have some room. Now, when it comes to buy limits, now it's basically going to be the opposite. So buy limit, placing an order below the current market price. So let's say the market is I'm trying to give you an example. So the market has come to this level and it's fallen. You believe somehow it's gonna just go back to the opposite direction. You're placing a limit for the market to go on a buy to take you the opposite direction. That's what a buy limit would be, right? You're saying price action has come back to this level right here, so you're gonna place your buy in here and then allow it to go back. The reason why I always tell people to be careful with this, because price action just doesn't go straight up and straight down. You might get price action come to a level and then it does something like this and spike down and come back and then take off. And so you just want to be careful. So you won't ever see us put in buy limits, because to me, those are really dangerous. To me, those are if you want to play those games with the brokers, the market makers, by any means, you knock yourself out. But when it comes to us, we will not be placing any buy limit, and yet alone a sell limit. A sell limit is going to give you the opposite, right? So saying that if price action is bouncing in its range, price action, you see price action is coming back to this level, you're going to place a sell stop, a sell limit, excuse me, right here, and saying that price action is going to go back to this level. Guys, we just do not play with the limits. All right. I would tell you caution, be careful, because again, price action doesn't just do that. It might come up, spike up, something like this, and then drop back down. So you just got to be real careful. So we're going to go over in terms of, how much we are always usually looking to risk per trade. We're going to cover that in the next few later on in this presentation. So now, what is a stop loss? A stop loss is a calculated measure of how much you are willing to risk in order to achieve profits. We recommend 10 to 15 pips max when risking per trade. So just like I was just covering, we always want to set parameters and what we're willing to risk to get what we want. So let's say, we're shooting for 40 pips, but we're willing to risk 10, right? So we have our stop loss. So we have our entry, okay? And then we have 10 to 15 pips to measure our in terms of how much we're willing to risk for this trade. This basically help us mitigate how much we could potentially lose, because one of the things we want to help you with is maximizing how much you gain. And so if we're risking, 10 pips to catch 40 pips, then that's a win-win, right? You always have to factor in a risk just in case the market does not do what we want it to do. All right, that's having a healthy balance of expectations. Now, what is a take profit, right? So a take profit is a calculated measure of an area you are aiming to target to receive profits. So when it comes to take profit, it's really important because we want you to be able to make money. So you have your entry, right? We have our entry. We know our stop loss because we just covered stop loss, right? So our stop loss is 10 pips, right? Right? Our stop loss is 10 pips. All right. So now we're shooting for, again, I say 50 pips. So this would be considered as our take profit, right? What we are looking to gain um, from this trade. So we're risking 10 pips to gain 50 pips. Our take profits is 50 pips. Hope that makes sense, guys. All right. So what is a trailing stop loss? Now, manually moving your stop loss into profit while still allowing your trade to breathe. This maximizes your profits and mitigates your losses. So basically what we were just covering. So we know that our stop loss is 10 pips. This is our entry. So to put yourself in a favorable position, what you want to do is, we saying we're going for 50 pips. So this is our take profit. All right. As this trade, let's say we got in, got down a little bit, start going up, right? What we want to do is just manually move our stop loss from here to here, giving a trade time to breathe. So if it does retraces back before getting to our take profit, then that gives us another opportunity to move our uh, new stop loss here. So we move from here to here, and ding, 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 we get our take profit. So this is really important. Uh, I'm a strong advocate for our clients, our students, our team, or using the trailing stop loss method because it allows us to not only allow our trade to run, but it also help us make more money and not having our stop loss all the way down to the bottom. So if we do get into profit, it's not just paper profits. And paper profits are basically someone who enter a trade and they see that price action went in the direction in their favor, and then they didn't take any profits off. They didn't book any profits. So we basically reassure ourselves by moving our stop loss into profit. All right. Now, what are the common ways to trade? Now, the common ways to trade uh, are three different ways that we're gonna really use, um, and that's gonna benefit our style of trading, which is technical analysis, fundamental analysis, price action. Now, technical analysis using tools to assist with predicting the direction of financial markets. So we do use a couple indicators, guys. We don't use a lot because it just doesn't really make sense because we want to be able to see price action. But we use these indicators in which we're going to reveal to you uh, for confirmation in the direction of where we're going, right? So the more confirmations that you have, the better. But we do not use technical analysis solely just to enter into a position. We do not do that. Fundamental analysis is using news events to dictate behavior movements in financial markets. So basically, people will use like an example will be Forex Factory. When you're looking at low impact, medium impact, and high impact news in terms of what can really impact the financial markets. Now, some of the things that I see that impact the fundamentals aspect is interest rates. You might have the like in our country, United States, we have the Fed chairman, right? So the Federal Reserve. In Europe, you have the ECB, right? And so different parts of the world, you might have their own central bank who impacts the monetary policy, economic outview of the economy, GDP. All these different things can impact from a fundamental analysis perspective, and also price action. One of the things we are really price action traders. And price action is so good because it is the ability to understand Japanese candlesticks to predict basic movements of price in financial markets. So we do have a few candlestick patterns that we look for specifically in our system. So we're going to reveal all that to you as well. So you're just going to have a complete guide and a guideline of what we use and a step-by-step guide, so you know what we're looking for when we trade. And then we're going to do live sessions together and things like that, so you can see on a consistent basis what that looks like. Now, guys, I really do appreciate you giving me the opportunity to go over what is forex and how to make money and the things that you really need to know. This is really going to be phenomenal for you all, and we look forward to seeing you grow mentally, professionally, and financially. And we do want to thank you so much for being the best part of Third Eye Traders. And remember, we'll see you on the other side. Until the next trading video.